AGOA expires. Is Africa ready to trade without America? Welcome to the Bold African Voice, BAV, where Africa's future is analyzed with courage, clarity, and critical insight. I'm Zainab Karoma. Today we tackle a historic moment, the expiration of AGOA, the U.S. trade lifeline that shaped African economies for 25 years. What happens when duty-free access vanishes overnight? Is Africa prepared to stand on its own feet, or will China and others swoop in to fill the gap? Stay tuned. We break it all down. On September 30th, 2025, the African Growth and Opportunity Act, AGOA, quietly expired, a legislative framework that for a quarter of a century redefined the relationship between the U.S. and sub-Saharan Africa. For the first time since its inception in 2000, AGOA was allowed to lapse, leaving governments, business owners, and workers scrambling. This is not just another Washington, D.C. policy hiccup, it is a defining moment in Africa's global economic engagement. Rosa Whitaker, one of the architects of AGOA and the first U.S. trade representative for Africa, reminds us that AGOA was never meant to be charity. It was designed as a bridge from aid dependency to trade dignity, and on the balance sheet, it has delivered. What AGOA actually achieved: trade diversification. Back in 2000, 90% of African exports to the U.S. were oil. Today, thanks to AGOA, oil is only 20%, while autos, apparel, and specialty goods account for billions in exports annually. Ghana's DTRT Apparel Group employs 6,000 workers, mainly women, producing for U.S. markets. Lesotho built an entire textile economy on AGOA, and Madagascar stitched its survival story into AGOA threads. Jobs across borders. Over 1 million jobs in Africa and 500,000 in the U.S. are linked to AGOA. That's not just economics, that's livelihoods, rent paid, and children in school. U.S. trade growth. Two-way trade grew from $28 billion in 2001 to $44 billion in 2024, with U.S. exports to Africa growing by 215%. That's American machinery, food products, and technology flowing into African markets. Development dividend: sub-Saharan Africa exported over $500 billion duty-free under AGOA, a figure that dwarfs many aid packages. Unlike foreign aid, this wasn't handouts. It was sweat production and export-driven growth. Budget neutral. To U.S. taxpayers, the cost of AGOA was negligible. For Africa, the returns were monumental. The expiration shock, why it hurts. The expiration of AGOA isn't just a technicality, it's a gut punch. African factories are freezing orders. Lesotho declared an economic emergency as garment exports collapsed. Madagascar leaders have already pronounced AGOA dead. Thousands of jobs for women, particularly in apparel, are hanging by a thread. The U.S. cedes ground to China. China now offers zero-tariff treatment to 100% of African products from its partner countries. And unlike Washington, Beijing doesn't spend years debating renewal. Since 2009, China has been Africa's largest trading partner, trading twice as much as the U.S. With AGOA gone, America has essentially waved the white flag in the global scramble for Africa's markets. Symbolic damage. For 25 years, AGOA symbolized a U.S.-Africa partnership built on more than aid. Its expiration tells African governments that Washington is distracted at a time when Africa is one of the fastest-growing consumer markets in the world. Africa-wide comparisons: winners, losers, and what's next. Winners, sort of. China and the EU both have aggressively pursued reciprocal trade deals with Africa. The EU has economic partnership agreements, EPAs, with several African regions, locking in preferential access. China, with its Belt and Road Initiative and tariff-free commitments, is eating America's lunch and asking if it can have dessert too. Losers: African women in textiles and agribusiness. Ghana, Lesotho, Kenya, Ethiopia, and Madagascar are the hardest hit. These economies don't have the fiscal buffer to subsidize industries until Washington figures itself out. The U.S. reputation. For Africans, this feels like déjà vu, from aid conditionalities to trade uncertainty. Washington looks like a fickle partner. Meanwhile, Beijing, Ankara, and even New Delhi are rolling out red carpets, sometimes literally. Forward-looking, what could replace AGOA? 1. A modernized AGOA 2.0. Not just duty-free access, but reciprocal trade that incentivizes U.S. exports. U.S. investment in Africa's critical minerals, cobalt, lithium, to compete with China's monopoly. Digital trade frameworks that reflect the continent's booming fintech sector. 2. Continental Solutions, AfCFTA. The African Continental Free Trade Area, AfCFTA, launched in 2021, already aims to boost intra-African trade. AGOA's lapse may ironically accelerate Africa's pivot inward. Instead of waiting for Washington, African states may deepen AfCFTA implementation. 3. Diaspora diplomacy. The African diaspora in the U.S. and Canada, estimated at over 4 million, can pressure policymakers to act. If a single tweet can shake markets, surely millions of African Americans and African migrants can influence Congress. A dash of humor. Imagine Lesotho trying to buy Teslas from the U.S. with its $2.66 per day average income. The Tesla rep would probably say, "Sir, for that amount, we can sell you one tire without the rim." Or take Madagascar, whose leaders joked that AGOA was already dead. One can almost picture them saying, if Washington can't decide whether to renew AGOA, maybe we should apply for Chinese citizenship. At least Beijing answers emails, the bigger picture, Africa's new trade courtship. The AGOA lapse is not just about tariffs, it's about influence. The U.S. has lost ground in Africa, not just economically, but diplomatically. With AGOA gone, America is no longer the suitor with roses at Africa's doorstep. Instead, Africa's dance card is filled. China, India, Turkey, the EU, and Russia are all waiting for their turn. The question is, will Washington show up again, or will Africa move on permanently? Recommendations for African leaders, turning expiration into opportunity. If there is one thing African history has taught us, it's that when one door closes, Africans don't just knock, they build another door. The expiration of AGOA can be read not as tragedy, but as a wake-up call. 1. Leverage AfCFTA as Africa's Plan A, not Plan B. The African Continental Free Trade Area, AfCFTA, covering 1.4 billion people and a combined GDP of over $3.4 trillion, is already the largest free trade area in the world by population. Instead of waiting for Washington's mood swings, African leaders should accelerate AfCFTA implementation, harmonizing customs, cutting non-tariff barriers, and expanding infrastructure that makes trade flow. Humor alert. Right now, it's often easier to fly mangoes from Accra to London than to truck them from Accra to Lagos. AfCFTA should fix that. 2. Diversify trading partners. Don't put all eggs in Washington's basket. While the U.S. debates trade policy, other partners are eager. The EU is expanding its trade agreements, India is deepening pharmaceutical and IT links, and Turkey is quietly building logistics hubs across Africa. And let's not forget China, already building ports, roads, and railways faster than you can say debt diplomacy. Africa should play the role of the savvy trader at the market. Take a little from each buyer, but never let one dictate the price. 3. Invest in value addition. No more raw exports. Africa has shipped raw cocoa, coffee, and minerals for centuries, only to buy back chocolates, lattes, and smartphones at 10 times the price. With or without AGOA, the continent must move toward industrialization and value addition. Imagine Côte d'Ivoire and Ghana, instead of begging for quota-free cocoa exports, setting up a chocolate OPEC. Prices would shoot up and suddenly Swiss chocolatiers would be learning twi. 4. Negotiate from strength, not desperation. The AGOA expiration should be a reminder that Africa is not powerless. With its critical minerals, booming population, and growing middle class, Africa has something every major power wants: negotiating new trade frameworks. Whether with the US or anyone else, should be done from a position of collective strength, not as fragmented states begging for favors. What AGOA renewal should look like if it returns. If Washington decides to re-engage, Africans should demand an upgraded AGOA, call it AGOA 2.0, that reflects today's realities. Reciprocal access. If Africa can sell duty-free to the U.S., why not open African markets to U.S. exporters too? But carefully, so African industries aren't suffocated. Digital trade and green economy. Tech, fintech, renewable energy, and climate resilience must be part of the package. Africa has leapfrogged in mobile money. Now it can lead in digital trade protocols. Critical minerals partnership. With the world rushing for cobalt, lithium, and rare earths, AGOA 2.0 should incentivize joint ventures, not raw extraction. Otherwise, Africa risks becoming the global battery farm without ever owning a Tesla. Stronger safeguards against uncertainty. No more waking up one morning to find AGOA expired. There should be automatic renewal clauses tied to periodic reviews, so factories in Accra or Maseru don't collapse every time Congress takes a nap. A reality check. Africa can't afford to wait. While Americans debate elections and trade priorities, African workers don't have the luxury of waiting. The 6,000 women in Ghana's DTRT factory or the tens of thousands in Lesotho's textile plants are already facing canceled orders. Each lost job is not just a number. It's a family sliding back into poverty. Meanwhile, Beijing has moved in with lightning speed. Zero tariffs, promises of infrastructure, and win-win cooperation, though sometimes it feels more like China wins twice. Washington may still be Africa's friend, but friends who forget your birthday don't stay in your good books for long. A little humor to lighten the trade. Tension. If AGOA was a marriage, Africa is currently standing at the altar, dressed in fine Ankara, only to find that Uncle Sam didn't show up. Meanwhile, China is sitting in the front pew with flowers, chocolates, and a signed prenup. Or picture this. African leaders calling Washington to ask about AGOA renewal. The phone rings and an automated voice answers, "Press 1 if you're from Europe. Press 2 if you're from Asia. Press 3 if you're from Africa. We're sorry, that option has expired." Country case studies, who wins, who loses, who adapts one. Kenya, the apparel powerhouse with political leverage. Kenya has long been one of AGOA's poster children. Its apparel exports under AGOA employ over 50,000 workers, mainly women. Nairobi used AGOA to anchor its export processing zones, EPZs, making Kenya one of Africa's largest textile exporters to the US. The risk. With AGOA gone, factories are cutting shifts, orders are being canceled, and unemployment is rising in industrial hubs like Athi River. The politics. Kenya, however, is in a stronger position. President William Ruto has already pushed for a U.S.-Kenya Strategic Trade and Investment Partnership, STIP, which could morph into a bilateral free trade agreement, making Kenya a privileged partner if Washington fails to renew AGOA for the rest of Africa. The humor. If AGOA was a school teacher, Kenya is that student who always does extra homework and hopes for extra credit. 2. Nigeria, oil dependency and the missed AGOA bus. Nigeria, Africa's biggest economy, barely scratched the surface of AGOA's opportunities. Why? Because AGOA's strength was in manufactured exports and value-added goods, while Nigeria remained addicted to oil. The risk. With AGOA gone, Nigeria hasn't lost much in apparel because it never built one, but it has lost the chance to diversify under a duty-free framework. The reality check. With its 200 million plus consumers, Nigeria's real potential lies in leveraging AfCFTA, not AGOA. But without fixing power shortages, port inefficiencies, and corruption, even AfCFTA might just be a fancy logo on government websites. The humor. Nigeria had AGOA for 25 years and still chose oil over everything else. It's like being given free gym membership for a decade and still blaming slow metabolism. 3. Ghana, from DTRT to AfCFTA hub. Ghana leveraged AGOA through DTRT Apparel, the country's largest private employer with 6,000 workers. Ghana's story shows AGOA's social dividend, women earning wages, sending daughters to school, and lifting entire families. The risk: expiration threatens thousands of jobs, especially in export factories. The silver lining: Accra is the headquarters of AfCFTA, giving Ghana the symbolic role of leading Africa's pivot to continental trade. If Ghana doubles down on regional markets, it could rebrand itself as Africa's trade capital. The humor: Ghana may lose AGOA, but as the AfCFTA HQ, it can say, if America won't buy our t-shirts, maybe we'll just sell them to Nigeria and send them the bill in advance for Ethiopia, from rising star to sanction casualty. Ethiopia once thrived under AGOA with its textile industry employing tens of thousands. But political instability, civil war in Tigray, and U.S. human rights sanctions meant Ethiopia was suspended from AGOA in 2022. The risk: even before AGOA expired, Ethiopia had already lost access. Factories in Hawassa Industrial Park shut down, leaving thousands jobless. The reality: AGOA expiration is just another layer of bad news for Ethiopia's already fragile economy. The humor: Ethiopia lost AGOA early, like a student suspended from school before exams. By 2025, it's watching other African classmates cry over AGOA's expiry while it shrugs, been there, failed that. 5. South Africa, the complicated giant. South Africa is the largest AGOA beneficiary by value, exporting cars, citrus fruits, and wine to the U.S. Its automotive exports alone account for billions annually. The risk: AGOA's lapse jeopardizes South Africa's auto industry, especially German-owned factories that use South Africa as a base for exporting to the U.S. The politics: Pretoria has had a tense relationship with Washington. Think neutrality on Russia, BRICS alignment with China. Some in Congress had already debated whether South Africa should even remain in AGOA. Expiration gives Washington an excuse to say, well, we didn't push you out, AGOA just expired for everyone. The humor: South Africa is like that big cousin at a family party, too important to ignore, but always arguing with the DJ about the playlist. The Strategic Balancing Act, Africa's multipolar future. What these country stories show is that AGOA was never a one-size-fits-all tool. Some maximized it: Kenya, Lesotho, Ghana. Others underutilized it: Nigeria, and some lost it early: Ethiopia. With AGOA gone, Africa must now balance between U.S., if AGOA 2.0 ever returns, still a lucrative consumer market; China, already dominant with zero-tariff frameworks; EU, formal trade agreements but heavy regulations, the rules police; AfCFTA, Africa's best chance at building resilience and reducing dependency. Advice to African citizens and entrepreneurs. While presidents and diplomats argue over frameworks, ordinary Africans can't wait. Here's the grassroots strategy. Build for regional markets. First, don't just dream of exporting to Walmart. Start with selling to Accra, Nairobi, or Johannesburg. AfCFTA is real. Use it. Digital trade is Africa's golden ticket. From fintech in Nigeria, Flutterwave, Paystack, to e-commerce in Kenya, Jumia, Copia, Africa can bypass physical export bottlenecks by scaling digital goods and services. Diaspora power. Africans abroad can lobby Congress, invest back home, and serve as trade bridges. If 1 million Africans in the U.S. decided to only buy African-made once a month, it could replace part of AGOA's lost demand. Value addition as religion. No more raw exports. If you sell shea butter, make lotion. If you export coffee beans, build cafes. If you dig cobalt, demand battery plants. AGOA's expiration is not just about tariffs and quotas. It is about Africa deciding whether it will continue to be a policy afterthought in Washington or whether it will grab the opportunity to reshape trade on its own terms. The lesson for African leaders is clear. Stop waiting for the West to validate Africa's growth story. The lesson for citizens and entrepreneurs is sharper. Don't let policy uncertainty define your hustle. Because at the end of the day, while Washington debates and Beijing invests, Africa still has the final say on how Africa trades. The Continental Strategy Blueprint, thriving in a post-AGOA World 1. Play 3 boards at once: AfCFTA, Home, USG Legacy, China, EU, India, Turkey Growth Board A. AfCFTA as the industrial heartland. Treat AfCFTA as the main market, not the warm-up act. It already links approximately 1.3 billion people and approximately $3.4 trillion GDP, the world's largest free trade area by number of countries. Prioritize cutting non-tariff barriers, digitizing customs, and solving last-mile logistics so a t-shirt can move Accra to Lagos faster than Accra to London. Board B, the U.S. as premium export and services partner. Even with AGOA lapsed on September 30th, 2025, the U.S. remains a lucrative services buyer. Washington ran a $5.5 billion services surplus with Africa in 2024. Tourism, transport, IT, finance. This is where African firms can keep selling higher margin services while goods preferences are in limbo. Board C, China/EU/India/Turkey. As volume, infrastructure, and rules. China just raised zero tariff coverage to 100% of tariff lines for LDCs with diplomatic ties, effective December 1st, 2024, notified to the WTO mid-2025, and separately announced 100% product coverage for 53 African countries, a signal that Beijing intends to capture post-AGOA volumes at speed. The EU's EPAs keep pulling African regions into structured access, but with rules police level standards. Calibrate. Use China for speed infrastructure, the EU for regulatory upgrading, India, Turkey for agile manufacturing and mid-tech. Quick reality check. Latest news. As AGOA expired, wire services and multilaterals flagged immediate job risks across apparel hubs, Kenya, Lesotho, Eswatini, while U.S. officials floated short extensions 1 year that may or may not materialize. Plan for the worst. Welcome any extension as upside. 2. Factory Africa 2.0. Move up the value chain, not out of the game. A. Lock in textiles and apparel, then climb. Stabilize orders with bridge financing and order guarantee facilities, so Athi River, Maseru, Accra plants don't die between tariff regimes. Build near-market inputs, regional fabric, trims, dyeing/finishing to raise local value add, meet origin rules, and survive preference swings. Fast-track skills academies co-run by anchor firms, think DTRT in Ghana, EPZ firms in Kenya, and technical colleges. DTRT employs approximately 6,000, a social dividend case study. B. Diversify into agro-processing, EV-era minerals, and green manufacturing. Agro-processing, cocoa to chocolate, shea to cosmetics, coffee to capsules. Critical minerals, link cobalt/lithium to battery precursor plants. Don't be global battery farm without factories. Green manufacturing, components for solar, wind, and e-bikes for intra-African urban logistics. AfCFTA cities are your first customers. C. Digitize compliance, EU deforestation rules, CBAM product standards. Becoming the continent that ships compliant goods is a durable moat, whatever the tariff regime. 3. A new export math, from US only to portfolio routing, route by margin and risk. Tier 1, premium brand sensitive, keep targeting US and EU retailers, hedge with private label in GCC and East Asia. Tier 2, volume price sensitive, push to China or India under zero tariff or minimal duty windows while AfCFTA demand scales. Tier 3, services and digital. Double down on IT support, creative industries, professional services into the US, Services surplus shows room to grow. 4. The no regrets playbook for governments, 90-day, 1-year, 3-year, first 90 days, triage. Stand up AGOA gap task forces with industry to map orders at risk and unblock port/power bottlenecks. Create temporary tariff insurance, rebates, freight subsidies, or working capital backstops, targeted at firms with demonstrated U.S. exposure. Use commercial attachés to reroute orders to alternative markets. China, 100% zero-tariff lanes for eligible LDCs, regional AfCFTA buyers. By 1 year, rebuild, conclude sectoral mini-deals, mutual recognition of standards, expedited customs lanes with top buyers. Launch skills/tech vouchers for factory automation, energy efficiency retrofits, and compliance software. Codify fast-track visas for technicians and merchandisers to keep supply chains agile. By 3 years, upgrade, commission battery chemistry pilot plants and cocoa, chocolate parks with anchor tenants. Convert 3 to 5 border posts into AfCFTA digital trade corridors, single windows, e-seals, 24/7 clearance. 5. Negotiating with Washington from favors to frameworks. If AGOA 2.0 reemerges, reports suggest short-term extensions are on the table. Pin it to predictability and modern scope. Automatic renewals subject to review. No more, wake up and it's gone. Digital trade, services, and green value chains built in. Critical minerals, partnerships that require local processing, not raw extraction. Utilization support for small economies, Lesotho, Eswatini, Madagascar, that are most exposed to apparel shocks. Humor interlude. If AGOA 1.0 was a generous date who sometimes ghosted, AGOA 2.0 needs to be the partner who puts reminders in the calendar and actually shows up, with a standing dinner reservation. 6. Balancing China without becoming dependent. Use Beijing's 100% zero-tariff pledge like a trampoline, not a sofa. Jump high, don't fall asleep. Conditions: demand local content and tech transfer in exchange for tariff privileges and market share. Pair Chinese finance with African/Western standards on environment and labor. Triangulate oversight. Think co-financing with IFC/DFIS for governance discipline. Reserve strategic sectors, data centers, backbone telecom for multi-vendor setups. Single-vendor critical infra is a long-term sovereignty risk. 7. Diaspora and cities, 2 underused engines. Diaspora demand can absorb premium African goods while policies churn. Mobilize Buy African once-a-month campaigns through churches, alumni, and pro-sports tie-ins. City-to-city trade, sign municipal MOUs, Lagos, Nairobi, Accra, Abidjan, Joburg, Cairo, for procurement of uniforms, school meals, sanitation hardware, industrial scale, without waiting for national tenders. 8. Country snapshots, operational next steps, add-on to earlier cases. Kenya, ring-fence Athi River jobs with a 90-day apparel stabilizer, deepen yarn fabric capacity, keep pushing the U.S. a stip track while hedging into GCC and EU buyers. Job risk already flagged by newswires as AGOA lapsed. Ghana, leverage Accra's AfCFTA HQ status to pilot digital certificates of origin and corridor logistics. Use DTRT as a training hub for West Africa. Lesotho/Eswatini, create sub-regional input parks so rules of origin thresholds are met regionally. Lobby for any U.S. bridge extension to explicitly shield LDC apparel. Lesotho officials have been publicly chasing a 1-year lifeline. South Africa, protect auto exports by negotiating targeted sector terms in any interim U.S. arrangement. Keep citrus wine lanes open. Avoid geopolitics derailing trade talks. Pretoria has telegraphed optimism on renewal, but expects only short duration. Nigeria, use AfCFTA first, fix ports, power, and FX to make diversification real. The prize is services plus agro-processing exports across West Africa, not a miracle U.S. pivot overnight. 9. For African firms, A simple checklist for Q4 to Q1 execution elegy. 1. Reprice SKUs by route, US tariff exposure, China, zero tariff lanes for eligible LDCs, AfCFTA, lower logistics. 2. Renegotiate Incoterms, share freight risk while rates are volatile. 3. Dual certify US/EU standards plus AfCFTA origin to keep optionality. 4. Automate compliance docs, e-invoicing, e-seals, traceability. 5. Hedge orders, 2 smaller buyers, 1 giant buyer in the interim. 6. Tell your story, impact plus quality, to diaspora retailers. U.S. services buyers already spend big with Africa. Lean into BPO/IT support growth. 10. The signal versus the noise, latest developments to watch. Extension. Watch U.S. officials and African ministers have floated 1-year stopgaps. Treat as bonus, not baseline. Job shock indicators. Apparel layoff notices in Kenya/Lesotho are the canary in the coal mine. Track factory order books monthly. China's tariff window. The 100% zero tariff pledge for LDCs is live. Align customs codes now so you can route inventory without surprises. AfCFTA. Implementation, watch pilot guided trade expansions and digital customs corridors. These will separate rhetoric from reality. A little humor to keep us honest. If AGOA was a long romance that forgot your anniversary, AfCFTA is the house you build together so you're not waiting on dinner invitations. And China? Think of it as the neighbor who shows up with a casserole and a survey asking if you'd like your kitchen remodeled today. Sector by sector plays for Africa in a post-AGOA era. 1. Textiles and apparel. Current shock. Kenya, Lesotho, Eswatini, Madagascar, and Ghana face immediate order cancellations. Play. Protect existing factories with short-term subsidies/bridge financing. Develop regional textile input hubs, cotton spinning, dyeing, to anchor apparel value chains in Africa itself. Secure dual certification, AfCFTA plus EU/US standards, so exports can pivot quickly. 2. Agro-processing. Opportunity. Africa still exports raw cocoa, coffee, and cashews while importing chocolate, instant coffee, and packaged snacks. Play. Establish agro-processing industrial parks, e.g., cocoa to chocolate in Ghana, Côte d'Ivoire. Push diaspora and AfCFTA markets for premium African-made brands. Partner with EU/Japan buyers demanding sustainable sourcing. Leverage new compliance rules as advantage, not obstacle. 3. Critical minerals and green tech. Reality. Africa owns cobalt, lithium, manganese, the new oil for EV batteries. Play. Demand local processing clauses in new deals. No more exporting raw cobalt dust. Court US/EU investment into battery precursor plants to counterbalance China's dominance. Use AfCFTA to build regional green tech clusters, solar panels in North Africa, e-bikes in East Africa, wind turbine parts in South Africa. 4. Services and digital economy. Hidden star. The U.S. already runs a $5.5 billion services surplus with Africa, meaning Africa is a real buyer of U.S. services, but Africa can flip the equation. Play. Scale outsourcing hubs, IT support, Nigeria, Kenya, animation film, South Africa, Nigeria, fintech, Kenya, Ghana. Promote remote work for U.S./EU firms. Africa's youth bulge is an untapped digital workforce. Build regulatory alignment, data protection, fintech laws to reassure Western investors. 5. Automotive, citrus, and wine, South Africa's stakes. Risk. South Africa's auto exports to the U.S. face tariff hikes. Citrus/wine sectors also vulnerable. Play. Fast-track bilateral sector deals, autos, agriculture, if AGOA 2.0 is revived. Use BRICS plus ties to expand South Africa's market beyond Washington. Diversify exports into AfCFTA. Supply parts and vehicles across Africa's urbanizing economies. Advice to African leaders. 1. Stop treating AGOA as a gift. It was always meant as a partnership, not charity. Negotiate AGOA 2.0 if it comes with reciprocity, predictability, and modernization. 2. Use AfCFTA as Africa's safety net. No more dependency on single external markets. Make intra-African trade your first guarantee. 3. Balance external partners. Don't swing from U.S. dependency to China dependency. Africa has leverage. Play multipolar diplomacy like a seasoned trader at the market. One buyer may haggle, but others will pay. 4. Champion value addition. Whether it's cocoa, cobalt, or cotton, Africa must ship finished goods, not raw inputs. That's where dignity and sustainable wealth lie. 5. Invest in people, not just policies. Skills training, digital literacy, and female workforce participation must be treated as national infrastructure, because without human capital, no trade deal will save us. Summary of key messages. AGOA expired September 30th, 2025 for the first time since its 2000 launch, leaving apparel factories in Kenya, Lesotho, Madagascar, and Ghana exposed to mass layoffs. China moved fast, offering 100% zero-tariff treatment for African LDCs and 53 partner states doubling down on its trade dominance. The U.S. still matters, especially in services trade, where Africa can scale IT, finance, and creative outsourcing. AfCFTA is the anchor market, treated as Plan A with external partners as Plan B and C. Sector strategies must shift from survival to upgrade, apparel regional integration, cocoa to chocolate, cobalt to batteries, services to digital exports. African leaders must negotiate from strength, not desperation. The continent's minerals, markets, and workforce give it leverage. Citizens and entrepreneurs can't wait. Regional trade, digital platforms, and diaspora demand are immediate lifelines. Final thought, AGOA's expiration is a test. Africa can mourn the loss of duty-free access or use this as the spark to build trade sovereignty 2.0, powered by AfCFTA, balanced global partnerships, and value addition at home. Because if the last 25 years were about America giving access, the next 25 must be about Africa creating access for itself and to the world. Thank you for watching The Bold African Voice, BAV. Remember, Africa cannot wait for handouts. Our future depends on bold decisions, value addition, and strong leadership. If you found this analysis insightful, hit the like button, drop your thoughts in the comments, and don't forget to subscribe and click the notification bell so you never miss an episode. Together, let's keep Africa's voice bold and unshaken.